In the finance YouTube community, I believe in transparency. Unlike a lot of other YouTubers, they don't show their entire portfolio, their gains, and their losses in stocks. They say they have great portfolios, they say they have the best stocks, but they don't actually show them and openly share how much money they've made or lost. You guys already know on this channel, I believe in complete transparency with my portfolio updates every month. Well, a viewer actually recommended that I share my entire portfolio's gains and losses, and that's what I'm going to be doing today. I'm going to be going through every position, what I regret, what I don't, sharing my future plans with every company in my portfolio, and so much more. And guys, if you appreciate the transparency and want to see more transparency amongst the finance community, hit that subscribe button for me, of course. We promote real man's investing on this channel, and with all that out of the way, roll the intro.
Hello, I like money.
Alright, the current recording of this video is August 10th, 2023, and we are on a green day today. Currently, my portfolio value is sitting right near $19,200, and I have roughly like $280 in cash right now, and I'm trying to conserve a little cash for the winter. To start off, we have Apple in the portfolio, and currently Apple makes up 8.43% of the portfolio. Right now, on my Apple position, I'm up 33.64%. I bought a lot in the 130s, 140s. Apple has been one of the best performing stocks in my portfolio, and I've been constantly told that Apple stock is overvalued when I continued to buy in the 130s and 140s. Right now, Apple is trading in the 180s. What did I do right here, guys? I bought what I knew. I knew that Apple was an amazing company, and I noticed trends in society that literally everybody was using an Apple product in one way or another, whether using a phone, AirPods, you know it, Apple is everywhere. Apple is one of the highest quality companies in the world, and in my opinion, a top 3 quality company. Apple is an amazing company that rewards me through buybacks and moderate dividend payments. In all seriousness, though, I knew Apple a lot. I researched Tim Cook. I really liked him, and I overall really thought I understood the business, and I knew the potential that they had with cars, healthcare, etc. Right now, I have 9.099 shares of Apple, and my cost basis was $1,200, and currently that's at a $420 gain. Wink, wink. As for what I'm doing with Apple right now, Apple, I'm kind of waiting for it to dip more. Right now it is on a dip, but if it gets below 170s and hits that 160s, 150s again, I will definitely be dollar cost averaging and looking to build that up to near 10% of my portfolio. The next company is a pharma giant, which is of course AbbVie, stock ticker ABBV. Right now, AbbVie makes up 5.36% of the portfolio, and I'm currently up 19.69% on the AbbVie position. Wink, wink again. With AbbVie, this is roughly a $250 gain. What did I do with AbbVie? I looked at the company's financials, and I bought it when it was undervalued relatively, and I bought in the 115s, 110s, etc. And look where it's at now. I believe that they could grow their other business segments when Humira would be expiring, and when others thought that Humira would completely crash them, and look where they're at now pretty much. Obviously, they're still dealing with some issues with Humira, but they are definitely building up their other business segments. Now, with AbbVie, what did I do right here? Admittedly, I don't completely and fully understand AbbVie's business, which is a mistake on my part, but pharma companies are very hard to understand in the first place, and I'm currently kind of studying up more on them right now. All I know with AbbVie is that they produce a lot of free cash flow. They pay a really great growing dividend. Unfortunately, they don't do buybacks yet, which I would like to see in the future. They have been diluting for a little bit. A few years ago, I saw AbbVie as fundamentally undervalued, and I saw them trading at a pretty big discount relative to their intrinsic value, in my belief. Pharma companies are the biggest and, let's just say, shadiest companies in the world, which as an investor is actually kind of a good thing. I really like where AbbVie's at in my portfolio right now, and if it were to ever dip into the 130s or 120s again like it did kind of last month, I would continue to buy. I bought last month at 135. Looking at AbbVie's valuation right now, it does look pretty undervalued, but at the same time, I don't completely and fully understand pharma companies in the first place, so I'm not going to go all out into it, making one of my core holdings. With that said, though, it is a pretty sizable position in my portfolio, and I do like AbbVie long term. AbbVie provides me with great growth and exposure to the pharma industry. The next company is the first company that ever bought my portfolio, which is Berkshire Hathaway Class B. Right now, Berkshire Hathaway is trading at $358.38, and I bought at $210. Currently, Berkshire Hathaway is up a whopping 72.39% of my portfolio. Now, what mistake did I make here with Berkshire Hathaway? I straight up didn't buy more because of the dividend. In my earlier years when the stock was trading 230s, 240s, 250s, I just didn't buy because it didn't have a dividend. That was an early investor trap that I made, and one that I regret right now. With that said, though, Berkshire is still buying back their own shares, and it does look a little appealing for me to dollar cost average into. And honestly, Berkshire Hathaway was a recommendation from a family member, so I'm not going to take complete credit for that one. With that said, though, I did do a little bit of research on their brands and the other companies that they owned, and I was impressed, so I bought. So with Berkshire, I'm up north roughly of $150 in that position. As I mentioned, I would like the dollar cost average into it if it becomes appealing or there's a bit of a big enough dip. The next company is a newer holding, which is of course Costco. And right now with Costco, it's a newer holding. I don't have a ton, but I am up 7.32% on my Costco position. It is a smaller position, only making up 0.84% of the portfolio, and I was dollar cost averaging into it, but it has been on a bit of a hike recently. I want to see where it averages out before I resume that dollar cost averaging. With Costco, I mean, I really like it. I understand the business model. I've done my research there. I understand it's a very high quality company. What did I do right? I bought in regardless of the really high valuation or what others say about the high valuation. I looked historically, and it historically trades at a higher valuation than other companies, and historically outperforms the market and rewards shareholders through buybacks and dividends. Right now, I'm only up like $11 on my Costco position, but it's still kind of nice to see. With Costco, I'm going to resume that dollar cost averaging where I kind of see where it averages out over the next week or two, but definitely is going to be a position that I'm going to look up to build in my portfolio for a bit. Alright, so far we've only seen winners in my portfolio, but here's the first loser, and it is a bad one, which is of course Walt Disney Company, stock ticker DIS. Disney has been a roller coaster of a ride. Today it's up 4% because of good earnings. Right now in my Disney position, I am down 35.36% and a loss of roughly $270 to $300. Now, what did I go wrong with Disney here? I straight up did not understand the valuations when I was buying in the 150s, 160s, 180s, etc. I just assumed that it would go up long term because they had made blockbuster movies in the past, and I would assume that they would continue that and grow their streaming. Well, let's just say I don't think that's the case anymore. Disney is just a pure example that something that has performed greatly in the past is not guaranteed to perform greatly in the future. Disney, when I bought in 2020, had previously released all the Endgame and Marvel films, done great with the Star Wars, and had a lot of promise with their streaming business. Now, it's not looking too promising, but with Disney's brands and their brand value, sometimes I wonder to myself, how can they possibly mess it up? And then they do something the next day stupid to tank the stock. I'll be honest, it's been a rough ride with Disney. Thankfully and hopefully they become profitable by 2024. They saw good free cash flow last quarter, and they affirmed that they would bring back a moderate dividend by the end of the year. Disney's really just got to focus on producing quality content again. A lot of the stuff that they're making right now is just trying to appeal to too many groups, races, ethnicities, etc. And I don't want to say they're becoming woke, but definitely they're sacrificing quality to try to appeal to more people, which I don't like at all. Right now with Disney, I'm just likely going to hold that moderate dividend. Will be interesting. That'll be really interesting actually to see where they put it at, what yield, what price compared to the old payout, etc. I'm just really hoping they become profitable on streaming by 2024, and hopefully they produce more consistent free cash flows in the future from then. Thankfully, Disney does have a booming parks business, which seems to be kind of holding them up right now. As for Disney right now, I'm just holding my eyes, praying that hopefully Bob Iger can dig them out of this hole and they get their brand reputation back. Alright, the next company is Corning, stock ticker GLW, and currently I am down 16.59% on my Corning holding. This is only a $27 loss right now with Corning, and honestly, I'm still kind of debating what to do with Corning myself. This is a mistake. I fell into the diversification trap when I started investing, just buying okay quality companies for the hell of it just to get that diversification. With Corning, it's a weird thing because they actually look alright financially, but it doesn't really meet the requirements to be a company that I'm looking to add today. And it's a very small holding at 0.73% of the portfolio right now. Likely I'm going to sell Corning, but I really don't know at this time because they actually have some solid dividend growth and financials look alright. So I'm kind of waiting to see what happens with Corning. With Corning, I just didn't really understand their business completely. I was at a stage in my investing journey where I was just buying okay companies, and I fell into that diversification trap. For Corning, it's only about a $27 loss, but it's still a loss at the same time. I'm not too sure exactly what I'm going to be doing with Corning. I'm most likely going to be selling it, ripping the band-aid, and probably allocating it into one of my higher quality, more core companies. The next company is, of course, Pierre from PK Investing's favorite, which is Johnson & Johnson, stock ticker J&J. With Johnson & Johnson, I am up only 6% on the stock, but I'm okay with that. It's obviously a slower growing company that's way more mature. Honestly, I wish I could have bought a little more Johnson & Johnson when it hit the 150s, but obviously J&J is not going to be 10xing every other year, guys. Much more slow growing, more boring company, which I'm fine with in my portfolio. You know, I'm obviously younger, but I do still want to have those boring, slow-growing companies at the same time that overall provide me with a solid total return over the long term. J&J only makes up 3.76% of the portfolio, which I'm fine with right now. I like where it's at in my portfolio. With that said, though, if it dips, I will definitely be looking to add if it goes back into the 150s again. But right now, with how they're performing, I don't know if that's going to happen. I'm happy where J&J is at right now, and I'm just going to let my dividends reinvest right now for them. Next, we have Coca-Cola, and I know dividend dude is spazzing out right now. And with Coca-Cola, I have a 13.36% return. I currently have Coke as 3.17% of the portfolio. Coke is kind of in the same boat with Johnson & Johnson, a way more mature, slower growing company. Very boring company. With that said, though, they still provide me a decent return over long term. With Coke, I'm not really eager to buy any right now, as I do think it is overvalued relatively. And again, for how young I am, it's not the most appealing to put my money into Coke, where I can get a much better return and a higher growing total return stock. I would say I definitely bought Coke at a better time than I did with Johnson & Johnson. I bought Coke in the high 40s and 50s. So with Coke, it's kind of in the same boat with Johnson & Johnson. I'm not buying any right now, so I do think it's overvalued, but I will be reinvesting my dividends. I'm not really eager to buy any more right now, but if it goes on a dip, don't count me out from adding to Coke. Next, we have Kroger, and Kroger makes up 3.73% of the portfolio right now, and I'm currently up 19.62% on my Kroger position. Kroger is one of those stocks that I just love for so many different reasons, whether it be the dividend growth, the amount of stores and brands that they own themselves, or what they're doing with robotics and automation. I love Kroger so much as a holding. Kroger is one of those companies that I bought when I realized that the financials were very solid, and it didn't seem that others really in the market really didn't realize its intrinsic value. Right now it's trading roughly at $49. I bought in the low 40s and even the 30s. I think Kroger is even a buy right now, and I'd like to see it near $45 before I seriously start adding a lot more to it, but I do want to build it up as a core position. Kroger just announced another dividend hike of 11.5%, which adds to their continuous streak of growing their dividend in an aggressive rate. So with Kroger, I'm up roughly 20% on that one. I just bought it at a really good time when I realized that the financials are solid, and I didn't think that the market really understood that and undervalued it. I like Kroger a lot. I'd like to buy in the 45 range, and I am reinvesting my dividends right now and letting the dividend snowball roll with that one. Next, we have the fast food giant, McDonald's, stock ticker MCD, and with McDonald's, I'm up 32.9% on this stock. McDonald's makes up roughly 5% of the portfolio, and I've only bought the stock 3 times in my entire investing journey. With McDonald's, I just bought what I knew, and I didn't really pay attention to what other people said about the stock's valuation. I bought it $190, $220, and $230. Today it's trading at $288. With McDonald's, honest to God, I kind of just got lucky a little bit here. I did simplify it in my buying process. I realized that McDonald's was an amazing business looking financially and fundamentally. They are obviously kind of a real estate company underneath, the fast food brand and icon that they portrayed to the public. I also saw what they were doing with like the Travis Scott meals, the Saudi meals, and like the Grimace shake that they just had, and I saw that was definitely a positive thing to get more traction into McDonald's stores. I also knew that McDonald's was an international icon, and that obviously won't be going anywhere in my lifetime at least, and I just bought in. As for McDonald's right now, I'm not buying. I'm just letting my dividends reinvest at the moment. I think it's a little overvalued, but if it gets down to $250, $240, I will definitely be looking at dollar cost average down and make McDonald's a real big position in my portfolio. Alright, you've seen a lot of winners so far, but here's one of the biggest loser, if not the biggest, which is of course 3M, stock ticker MMM. By the amount of dollars that I've lost on this position, 3M has definitely been my biggest loser. I initially wanted 3M to be a core position of my portfolio simply because they had a huge track record of great performance, paying back shareholders, etc., and having an amazing business. Today, their business is actually still performing well if you look financially, but that's obviously been overridden by the dark cloud that is the lawsuits that they're facing right now. Those lawsuits have impacted their financial metrics, such as EPS. Right now, with my 3M position, I'm down 33.73% or $350. With 3M, it's definitely been a more depressing road to go down. With that said, though, this is a company that I still believe, if they can get past these lawsuits, is a good business to own long term. I'm being very patient with this company right now, and I'm reinvesting my dividends at these low prices, but I'm not really eager to buy simply because of the huge risk that there is. Unfortunately, I bought a lot of my 3M position before the lawsuits actually were a thing, and a big risk to the stock, so my cost per share is really high up there in the high hundreds. Where did I mess up on my process with 3M? I think the big thing really was just assuming that past performance would guarantee future good performance. 3M was just a giant loved by dividend investors just a few years ago, and look where it's at today. It's one of the most hated stocks amongst the community. So obviously I didn't do the full research. I thought they would be a giant. With that said, though, I understood their business and how big they really were, and they're still a huge business overall. So with 3M, I think the biggest lesson, past great performance doesn't indicate or guarantee any future great performance. Same can be said with Disney as well. I just bought assuming they would continue their business operations with not really looking too deep into any risks or whatever, and look where I'm at now. It's one of the biggest mistakes that I've made so far. Do I think 3M will cut their dividend? That's another question I've been asked. I don't think so at this point. I think if they were to do it, I think they would have already. Right now with 3M, there is still a whole lot of risk with those lawsuits, and I'm not particularly eager to dump a whole lot of money in and get my cost per share down. With that said, though, I still am reinvesting my dividends. Alright, next we have Altria Group, stock ticker MO, and with Altria, I am only down 1.36%, but my total return is a little higher than that considering the dividends that I get. Obviously, with Altria, I am reinvesting these dividends back into them right now. With Altria, I don't think I've really done anything horrible here. I like where it's at in the portfolio. It's not a huge holding, but it's still a sizable amount of money that I have in the company itself. I think Altria's business is actually very strong if you look at its cash flows, etc., its pricing power that they displayed last year, price increases, etc. With Altria, I am up right now in the position, even regardless of the 1.36% loss it says on the capital appreciation side of things. Altria really hasn't gone anywhere when it comes to capital gains. Altria obviously has an amazing dividend when it comes to yield, and their growth is solid as well, but they also perform share buybacks as well. So those are some of the areas you can get your gains from. Altria, you're obviously not going to see huge capital gains, as I mentioned. You're not going to see a 10x in 2 years or whatever. I think it is at attractive value right now. With that said, I'm just reinvesting my dividends and letting my dividends compound. Alright, next we have one of my best performers, which is Microsoft, which is up 35% right now. With Microsoft, it was one of those companies that I knew how great of a giant a company it was, how much potential it had with gaming, cloud, etc. And I bought in a lot during the 200s, guys. I'll be honest, this is where I really loaded up on my position. 230s, 240s, 250s, all that. Microsoft is currently the largest position in my portfolio, making up 10.21% of the portfolio. Microsoft has been on quote-unquote of a bit of a dip recently, even though I don't think it's attractive enough for me to continue adding. You guys know me. I will buy a great company no matter what the circumstances are, no matter how much I own. If it were to actually become appealing for me to buy again, I would have to get down to 280. What did I do with Microsoft? I think I nailed the coffin here with how much I did research on it, how much I really understood their business overall, the cloud, etc. I think Microsoft is the strongest company in the world with all the assets that they have, and just really understanding how much of a giant company they are, how many people use Microsoft products every day. With Microsoft, I just recognized a really high quality company, and I saw that it was undervalued to where I believed it should have been trading at, and I just loaded up from there. It was really as simple as that. Right now I'm just holding on to Microsoft, but as I mentioned, if it gets onto a big enough dip down to the 280s again, I will definitely start to look dollar cost averaging back into it and just continue building up my position when I think it's fundamentally undervalued. Next up, we have NextEra Energy, stock ticker NEE, and this has been kind of a weird one. I'm down 15.49% on this. It's a utility. I'm still kind of doing my research on utilities right now. With that said, I think NextEra Energy is a solid quality company, especially when it comes to new clean energy, quote unquote. They're really big involved with that. They have been on a bit of a dip recently, but they also do grow their dividend at a pretty solid rate. I'm doing more research on utilities as we speak right now, and if I see NextEra Energy as an appealing buy, I'm probably going to add to get my cost per share down. They do have a solid growing dividend though. Next we have Nike, which I'm down 23.24% on, and with Nike, the simple mistake here, I didn't understand valuation at all when I bought in. I just kind of went with the assumption that Nike would be around for a long time. With that said, though, I think Nike is an amazing quality company. I just bought it at a horrible time. We literally bought at the top of the bull market in 2021. Nike is a company that has great financials, great growing dividend, do share buybacks, etc. They're a very high quality business, great brand value, pricing power, and more. If Nike dips below 100, I'll probably dollar cost average in to get my cost per share down. I do think Nike, though, is a very high quality business regardless of the horrible price that I bought it at. What's the mistake here? I bought it at a terrible time and I didn't understand valuation at all. Guys, understand valuation before you buy stock because that's how you really get your total return. Alright, next we have Realty Income. With Realty Income, I am down 6.67%, and this has been one of the slower growing positions in my portfolio. I think Realty Income is a high quality REIT with really strong tenant base and a recession proof business model when it comes to their tenants and how well they do during recessions. With that said, I think their dividend is a staple right now, and you're not going to see huge crazy growth in them. At the same time, I do think they are undervalued right now, which is, I think, a reason that little gain. I'm pretty much flat if you include my total return with the amount of dividends that I get from them. Right now, with Realty Income, if it gets down to 55, I'll probably look to buy, and I am reinvesting my dividends every month. Next, we have Pepsi, and with Pepsi, I'm up nearly 25% on the 2 shares that I own right now. With Pepsi, I do think it is expensive right now, along with Coke. Pepsi is a very small holding in my portfolio, only making up 2%. And with Pepsi, I just recognize the great brands that they own. I just bought. Pepsi's payout ratio is a little bit concerning right now in their free cash flow payout ratio, but they're a staple of a business and they're not going anywhere. Alright, the next company is of course Starbucks, stock ticker SBUX, which makes up 7.15% of the portfolio at a 15.34% gain. Starbucks is one of those companies that I was buying when nobody believed in the company. Everybody thought the unions were going to tear them down. I was buying in the 70s and 80s. With Starbucks, I just think I really do understand the business model very well. I understand how their business operates. I also understand how great their free cash flows are right now, financials, how great their dividend is growing, the share buybacks, etc. It's just one of those companies that I think I really nailed the coffin on my research, my entire process. Right now, Starbucks is a core holding in my portfolio, and it's actually been on a bit of a dip recently. I think I do have some room to grow my Starbucks position in my portfolio a little bit, and if it dips into the 90s, I will be definitely adding a little bit day by day. So many things I love about Starbucks, and it's just one of those holdings that I love because I really nailed my process on it. Alright, next we have a company that I've been known to talk about a little bit on this channel as well, which is Target, stock ticker TGT, and with Target right now, I'm down 17.6% on the position. Starbucks is one of the bigger losses in my portfolio right now, but I am really dollar cost averaging and trying to get my cost per share down, as it has been on a huge dip recently. I'm of the mindset and my investment thesis on Target is the U.S. economy continues to grow over the long term. Target will follow. It is a very cyclical business. During the good times, everybody wants to own the stock, and during the bad times, it sells off a lot. I want to build up my position during the bad times and get rewarded during the good. I actually just made its Target stock review where I went really deep into the company, its performance, risks, etc. If you're interested in the stock, I highly recommend you check out the video. Links in the description or in the top right corner right now. It's the highest quality stock analysis / review that I've ever done on the channel so far, and one of the highest quality videos that I made so far, so I'd really appreciate if you check that out after this. With that said though, Target is in the range right now where I'm definitely looking at dollar cost average and get my cost per share down. Target only makes up 4.03% of the portfolio, but I'm aiming to make it to 6 to 7% if capital appreciation actually picks up during a bull market or some other time with it. Alright, next we have a very new holding, which is Texas Roadhouse, which I've only had in the portfolio for around a week right now, and I'm only down 1.4% of the position. I'll keep it brief here, but if Texas Roadhouse continues to dip near 105, 106, I'll continue to dollar cost average down. Texas Roadhouse is a company that I'd like to build up maybe into the 3 to 5% range. Next we have the railway giant Union Pacific, and with UNP, I'm up 15.76% of the position. Union Pacific I bought around 200 range, and it's been on a bit of a climb recently with the recent hike because of the new CEO, Jim Vena. The United States really relies on railways and companies like Union Pacific, and I really want to be an investor in these industries. What did I do right with UNP? I just really realized an industry and a company that looked really well financially, and I realized an industry that really is kind of monopolistic in a couple senses, and I realized an industry that's very hard to compete with, high barrier to entry, etc. Alright, next we have a smaller position in UPS. With UPS, I'm up 3.37%. UPS rewards shareholders through nice buybacks and juicy dividends as well. They've just come to an agreement with their employees on basically a new union agreement, which allows UPS drivers to make $180,000 a year. For shareholders, this may not be the greatest thing, but I think long term it's a good move for the company. UPS, I gotta do a little more research before I continue adding. Next, we have one of my favorite companies, which is Visa, stock ticker V, and I'm up 14% on this position, and it's a position I really want to build up. Very monopolistic in a couple senses in the payment processing industry. Visa and a MasterCard have a duopoly right now in the payment processing industry. With Visa, I want to make it a core position, make it one of those Microsoft positions, make it up 10% of the portfolio. Right now it makes up only 5.42%, but I definitely want to continue to dollar cost averaging and buy on dips. I think it's relatively at a fair price right now, this 230, 240 range. Next we have Vici, which I'm only up 1.14% on the portfolio right now, and Vici's been one of those companies, it's just been trading flat for a whole lot of time. Thankfully, though, they have paid me and rewarded me through a lot of juicy dividend payments, and they've definitely grown their business since I've initially bought in, diversified a lot, which I want to continue to see. Right now, Vici makes up 3.95% of the portfolio, and I like where that's at right now. And for my last actual position here, we have Waste Management, stock ticker WM, which I've been actually buying a little bit up recently, and I want to build it up as one of those core positions as well. It's a very strong utility company. It only makes up 1.38% of the portfolio right now. With Waste Management, I'm up really 20% on the company currently. It was one of the first stocks that I ever bought. Obviously, we're going to have trash forever. It's a recession-proof business model, very strong business. And lastly, guys, we have SCHD, which makes up 9.95% of the portfolio, and I currently have $1,900 worth of it, and I'm only up 1.68%. SCHD, for me to really be looking to add again, I do have to go below like $71, $70 again. I already have a sizable amount, and I really like where it's at in my portfolio. I like where SCHD right now is at, and I'm considering adding VU or SPY potentially long-term in the portfolio. So right now with my portfolio, I'm only up 8.15%, which is underperform the S&P 500. But am I really that bad of an investor? Well, here are the few of the issues I made. One, I over diversified. I have too many companies in my portfolio right now, and I admit that. I am looking to consolidate. Two, a lot of the companies that are kind of holding me down right now, like 3M, Disney, etc., those are the ones that are really keeping me from outperforming or staying in performance. Those are companies that I'm really just holding for the long term, embracing for impact. I also did buy a lot during the 2021 bull run when I really started building this initial trees and saplings for my investments currently. Alright, those are all my gains and losses exposed for my portfolio. Again, the recording this is August 11th, 2023, guys. If you made it to this part of the video, I really do appreciate it. This took a long time to make, so if you do appreciate that and you appreciate the transparency, make sure to hit that subscribe button. Join the Discord link in the description, and of course, guys, thank you for watching, and do dividends, stocks, not drugs. Have a good one.